My name is Zach, and this is still Dividend Data. Now, this is a different style of content. I'm on camera. That's a face reveal, I guess, for those of you who wanted it. So what prompted this change? Well, April has been a big month. I turned 25. We're having the 4-year anniversary of me starting this channel. I started it in college, and during that time, I was getting really into investing and personal finance, and I documented me growing a $30,000 dividend investing account to $160,000 now, which I update every month on the channel. You guys have watched, many of you. I also did stock review videos, which were highly researched and produced, and basically, every single time I would make one of those, you are like writing a research paper. And like, for example, I did an NVIDIA stock review a few months ago, and that was, I think, 11 or 12 pages. And I basically went through like the whole history of the company, all their competitive advantages, the technological advances that made this recent AI boom possible, and then like the stock analysis, of course. I made that. It must have taken a week and a half to do. And it only got like 10,000 views, which if you're in the YouTube space, that's not really a good use of time for the most part. I also started to feel some of my content was getting repetitive, and I was definitely getting burnt out at points making it. And I think the audience was feeling that in some ways where it felt like I was just making some stuff so I could show off like my website, dividenddata.com. That's another point. 2 years into the YouTube channel, I kind of switched focus significantly into programming dividenddata.com and launching that. It's a stock research and portfolio tracking tool. So that is another big part of my journey, and it did distract me from YouTube. I kind of had the idea to switch up and evolve my style much earlier. I was thinking either podcast or just like on camera, because I really did not find the research paper video essay style to be sustainable long term. And it definitely does lead to burnout. Like, for example, this video will have way less pre-planning, and the editing will be significantly easier. So like it will take 1/10 of the time, if that, to make. And it will probably do as well, if not better, and it will provide value in new and unique ways. For example, now I can cover topics that I wouldn't have before, whether because I didn't want to, write a 3-page paper about the topic, but I was interested enough to have like a minute's worth of comments and thoughts. This week, for example, Tesla has earnings, so I'll definitely be recording my reactions live to that because Tesla is one of my biggest holdings outside of my dividend account. It also opens up the idea to broaden the channel a little more. Dividend investing, personal finance, stocks, all of that will still be a core focus, following legendary investors like Warren Buffett, Charlie Munger. But now I feel like I can be a little more raw and, real. And I hope some of you enjoy that. So what is this new style going to look like? Well, I'm planning to upload weekly. Right now, I think Fridays at 11 a.m. That's my going number. The style of the content will be following me like Monday through Thursday, looking at my portfolio, analyzing stocks, any news story that comes across that I find interesting enough to comment on, reactions to videos. Also probably like a little behind the scenes, me working on dividenddata.com and like the problems that come up. Some of you may find that interesting. That is how I spend like a lot of my time nowadays, thinking about ways to improve and develop that. So anyway, we should probably just jump into the first video. Let's roll the intro.
But how do I make money?
Hello, I am in my kitchen. I just got back from Sam's Club with my dad. He is also into dividend investing and is a member of the community. He's in the Discord. If some of you definitely have interacted with him. Just came back from Sam's Club. Sam's Club and Costco are the mecca of retail capitalism in the United States. Big fan. $1 hot dog combo. The best deal is the $4.99 rotisserie chicken. This thing, that's like 2 meals. I'm a big dude, but fantastic value. That's what they call a loss leader, so that they get you in the door. And then they upsell you on the other things. I made a full Costco stock review video in the past. Fantastic business model. Stock has done very well. Go check that out if you're interested. So anyway, I still have a lot of work to do today, so I'm going to make dinner, eat, and then get to work, and I'll cut to that. All right. Well, hello. I'm going to be looking at the current market today for Monday. Markets are closed already when I'm giving this update. Sometimes I'll be really on top of it during the day, but the longer you get into investing, the more you realize that an individual day really does not mean that much in the grand scheme of things. If you're specifically trying to target a stock, then it's good to keep up with where the pricing is in that day and kind of like the sentiment and momentum of the market. But unless you're day trading, which I'm not, I'm long-term investing for the most part, you don't need to be lasered in all day long. At least that's my thoughts. But yeah, the market was up today overall. But Tesla, which is one of my largest positions across all my accounts, that was down 3.4% again today to $142, which is it's starting to get to a pretty interesting range for pricing. I've nibbled in the 180s over here in January, and I bought again in January, like around 110, January of 2023. And I'm really thinking that we're lining up for a good buying opportunity again. They have earnings on Thursday. Deliveries are low. We already know this. We'll talk about this later during earnings for Tesla. I might nibble again prior to earnings and buy some. Really, if it's 130s and below, I'm probably going to be putting in about $7,000 and do my Roth for the prior year. Actually, no, the Roth for 2024. But anyway, yeah, the market was up pretty much other than that. I had buys in for Altria around $40, but it's gone up like 3 days in a row. So I'm surprised Disney is down actually, because Netflix, I found their earnings to be pretty good. And we might watch a little of their earnings call later. I added up and I watched like a quarter of it a few days ago. So I'll probably keep watching some of that. But in terms of news, there were some dividend increases announced today. Ameriprise Financial was up 9.6%, which is a pretty big increase. That's around what their typical rate is. But that stock, I have it on my watch list, and some of you have been pointing me towards it in recent years, and it does look pretty interesting. The earnings grow at a much higher rate than, they haven't fallen off as much as like T. Rowe Price has, because their business model is slightly different. It's much more of a financial planning and wealth management business. Southern Company is another one people own a lot. It's up 2.9%. I don't have this. It's much more of a slow growth stock, and utilities in general, I am just not a big fan for the most part. They're highly regulated. They grow incredibly slow. They have massive capital expenditures. It's just like, if you're ready to retire and you want the dividend income now and you find it at an attractive yield as well, like 3.84% for this slow growth, I'm not tempted by that really at all. Another interesting thing, I just did a video about this with Globe Life stock. They're still down 42% from their 200-day price average, but it's up like 10% from when I made a video on it, which is pretty interesting. I saw some people comment that they're like, "Oh, thanks Zach for the tip or whatever." It's like, hey, not financial advice, but it has gone up since I made the video. They just released earnings, so let me actually check in on that to see what it is post. All right, so it's only up 1.69% so far. All right, so their earnings call is on Tuesday, April 23rd, so tomorrow from when I'm recording this. So I'll probably check into that to see. I thought there would be a bigger move, to be honest, afterwards, so I don't know if they put out commentary yet specific to the massive short seller report by Panda Research, blah, blah, blah. I made a whole video about it if you want to go learn more. So anyways, that was today's market movement. I might buy some Tesla later this week. Visa, I want to buy more just because it's such a solid business model, but it's not cheap at the moment with 272. Maybe in the 260s, lower 260s, I would start to buy some. Altria, I have some buys in at 40. If you don't really have a position and you want to build in Altria, then, this is still a pretty good price. What's the yield right now? It's a current yield, 9.21%. That's I mean, for a high yield stock, you're not going to find many options that have, 4% dividend growth with a 9% starting dividend yield. But yeah, so that's my biggest dividend payer, and it's going to end up netting me about $500 on April 30th for their upcoming dividend, which will be nice. All right, I'll check in with you guys later. I am about to watch the new Deadpool and Wolverine trailer. I like the MCU, invested in Disney stock. This movie will probably be one of the biggest movies of this year in terms of box office, so it will be interesting. So I'm kind of excited to watch the trailer.
I don't know anything about saving worlds, but you do.
Trust me, kid, I'm no hero. You were an X-Man. You were the X-Man. I am soaking wet right now.
Boys are so silly.
This is what I'm talking about. Big slow motion action sequence. Who knows if you live or die? Let's fucking go.
Let's fucking go.
That looked good. Probably not going to make the final video. Hello, humans. I am back. All right, so I just edited together some of the clips that I recorded today for this episode, and let me tell you, I should have started doing this way earlier. Also, I recorded a new version of the intro video. It's shorter because I didn't want to do a 40-second thing, and I kind of combined two different intros I had made in the past. One, the one that you guys in the comments say is iconic and everything. And if it is, well, let me know. Maybe I'll bring it back. I tried to merge the best of both worlds. The 40-second intro thing, I don't know if that's like a good idea. So I tried to keep it brief. I thought it was fun. Let me know what you think. But anyways, I'm going to watch this Netflix earnings interview. And by the way, more companies should be doing this for their stocks, posting it on YouTube with videos. Netflix, this is so professional the way they do it. Also, their earnings was great. Big beat on memberships. They have a lot of different revenue streams opening up with advertising, paid sharing, and now they're just building a giant library of, IP and content that they will be able to monetize in the future. Now they're in a much earlier stage of that in terms of a media company compared to like Disney or something like that. But they've definitely proven that the streaming model will be very successful going into the future. All right, so I found an interesting moment in the Netflix earnings call where they were talking about how they're getting into live sports. I don't know if you saw the Jake Paul versus Mike Tyson fight that was announced to be exclusive streaming live on Netflix. That's a big deal. In terms of streaming and sports, that's one of the slowest things to transition to the new business model. This past fall in the NFL, there was a NFL playoff game that was exclusive to Peacock, and that currently holds the record for the largest streamed live event. Now, obviously, there has been much larger things across cable plus streaming and blah, blah, blah throughout history. But in terms of an exclusive streaming event, I think that this Netflix Jake Paul versus Mike Tyson has the chance to break that record, probably by a wide margin, considering that Netflix is a much larger platform than Peacock. So anyway, here's them talking about their sports strategy.
So we're in the very early days of developing our live programming. And I would look at this as an expansion of the types of content we offer, the way we expanded to film and unscripted and animation and most recently games. And starting in January, we've got 52 weeks of live sports with WWE Raw. That's going to be coming to our members every week on Netflix. And we think it's going to be a real value add to watch those things in real time. And we're going to continue to try a lot of new things. But the core of it is do our members love it? And judging from the early excitement around the Jake Paul Mike Tyson fight, there's going to be a lot of people waking up in the middle of the night all over the world to watch this fight in real time.
I think worth noting that, just as what's relevant to members in terms of these, large cultural events that Ted talks about, that's what has relevance to advertisers as well. So it's an opportunity for us to expand our advertising offering and give those brands access to these kind of culture defining moments.
Yeah, we've said this many times, but not anti-sports, but pro-profitable growth. And I think that's the core of everything we do in all kinds of programming, including sports. So our North Star is to grow engagement, revenue, and profit. And if we find opportunities that we could drive all three of those, we will do that across an increasingly wide variety of quality entertainment.
Netflix at its core is a membership business. Now they are hyper oriented around entertainment, with scripted TV series, movies, reality TV, etc. But they're expanding and broadening the definition of entertainment in that they're adding video games, and live sports seems to be one of those next steps to add more value to their members. In the same way that Costco, which I mentioned earlier in this video, is trying to provide value to its members, through cheap products, good deals. In the United States, you would probably say that Amazon Prime, Costco, and Netflix are the largest and highest quality bang for your buck memberships you can get. They're actually starting to become a very interesting stock as well because they are now highly profitable. Now, in hindsight, Netflix stock was a no-brainer in that 2022 crash for pretty much a year or so. And I did not buy any, even though mentally I told myself, Zach, you should probably buy some. But I did not. That is me with, so many different stocks. And you can't get really upset about yourself with missing that. You really just need to keep stacking experience and knowledge onto each other. And eventually your intuition and feel will kind of get better for buying. At least I feel like it's gotten like that for me. But yeah, they just had record high earnings per share. Revenue is finally accelerating again, which is great. And with free cash flow, dude, this is what I'm talking about. Netflix, that subscription model, it has gotten to the scale and pricing where it is a free cash flow machine now. And Netflix has basically proven that they are set on that path. They have made it. They are one of the ones that have made it. Now, as you guys know, I also own Disney stock, which in the entertainment space, I think they also have a chance to make it. And I do think that's a really big opportunity long-term for Disney. Their streaming business will basically be a Netflix within that company. It will take longer, but it will eventually hit, I assume, probably similar revenue and profitability, but they'll probably be at a 4-year lag or 3-year lag. But then with Disney, they're far more diversified in that you have all the other ways they monetize their IP through, licensing, merchandise, etc. But then you also have their parks, which they basically have the best theme park business in the world. And Disney streaming services are finally going to hit profitability in 2024, which is a big deal. And then hopefully it just keeps stacking slowly year after year. And eventually, it could be on Netflix's level. But Netflix, they're already there, so bravo to them. So tomorrow I need to work a lot more on website development. I'm building a stock screener, which will probably be on this research page. I don't know whether I'm going to have it be a separate tab here or have it integrated and either replace or add multiple tabs here, like the most actively traded stocks. And basically you could add filters and, create a list to find different stocks that fit, your criteria, look, market cap, sector, industry, dividend, etc. This has been a requested feature for a while, and the goal is to start working on it tomorrow. So we'll probably cut to that. Hello, it's the following day. So we got some big news today. I'll start with Globe Life stock. So they had their earnings call earlier today, and now it's up 14% to $75.84. So those people that were happy that I made a video about it, they should be even more happy now. I was also caught off guard a little bit, though. I thought Tesla was later in the week for their earnings, but it was actually Tuesday after market close. So they were up 1.85% today, and they are up an additional 10.8% after hours. So it looks like I made the wrong call not buying so far, but we'll see how they react tomorrow. Later, I'll definitely be listening to the earnings call. But first, I have to make myself go to the gym, and I do not want to go. It's leg day. Ugh. It's the hardest day. I have to do heavy back squats. I don't want to do it, but I know I'll feel better after doing it. And sometimes you have to do things you don't want to do. That's life. All right, guys, back from the gym. Much needed. It was hard, but you do it. It's whatever. I'll probably have jelly legs tomorrow. So first, I'll give you a little market update of what happened today. All my accounts, they're up about 1%. This was led by Microsoft, up 1.65%. Tesla during trading hours was up 1.85%. You got Disney up 1.5%. Broadcom up 2%. Biggest loss on the day was PepsiCo, down 2.97%. And then I mentioned this earlier too, but Globe Life, that went up 14.11% today. So I probably should have bought when I made that video. You know, you live, you learn. But the big story this week is that it's earnings for a lot of companies. Today we had Visa, Tesla, PepsiCo, GE, and like many other big companies who I'm sure many of you own. We got Meta, IBM, AT&T tomorrow. Thursday we got Microsoft and Google, so that's a big day. And then Friday, it probably won't be included in this video, but Exxon and Chevron report. I own both of those in my portfolio. AbbVie also reports that day. Many of you own that stock. It's big in the dividend growth community and has been for a while. But today I'm going to briefly check in on Visa's report and then dive into Tesla's because that has a lot of news around it and it's one of my bigger holdings. So Visa after hours is up 2.2%. They beat their EPS estimates and showed continued double-digit growth year over year. Visa is one of those companies where the story around the stock doesn't really change that much. It's one of my larger positions in my dividend stock portfolio and I plan to continue increasing that over time. I probably will start just dollar cost averaging over this year, and whenever there is a big dip, then I'll probably go heavier into it. Long term, I wouldn't mind if it was like up here with Microsoft as one of like my core holdings. The main risk with them is that their business is so dominant, they might be regulated away. So we'll see. Tesla stock is up over 13% after hours. So there must have been some great news on that call. And it looks like I missed my buying opportunity, which I was hoping to get this week. However, 163 is still a pretty good value long term, in my opinion. That said, I still think there will be a lot of opportunity throughout 2024 because their financials were not good this immediate quarter. And the next couple quarters probably won't be that great either. So if the overall market starts to downturn a bit and Wall Street starts wanting immediate profits, I do think there is ample opportunity for Tesla to fall even more this year. However, long term, there is a lot of catalysts. We got self-driving, we got their low-cost vehicle program around $25,000. That's the rumor. We got Tesla supercharging becoming kind of the standard in the United States. I think Tesla Autopilot may be licensed to other manufacturers, but we don't know that yet. And then long term, I think the Tesla bot over the next, 10 to 20 years, it might be bigger than the entire automobile business. So that will be a huge growth driver for the company. But here's the thing. A lot of that doesn't really exist and is monetized right now. So Wall Street, they care a lot about what's happening right now. All right, so I'm going to read through their Q1 update, listen to the earnings call, and I'll cut back to you guys if I have anything interesting to share. All right, so I'm in the Q1 deck. And as you can see, it was not good at all. So their total automotive revenues were down 13% year over year. Energy generation and storage only grew 7% year over year, which is a big decline from prior years. Total revenues down 9% year over year. Total gross profit down 18% year over year. Their operating cash flow was down to $242 million for the quarter. This is a 90% reduction from Q1 2023 to Q1 2024. However, capital expenditures continued growing as they're investing in the future, new manufacturing lines, etc. So free cash flow for the quarter was negative $2.5 billion, which is down 674% year over year. They have 26.68 billion in cash and cash equivalents. So their balance sheet and situation is still very strong and good. However, their earning power right now is not ideal. And we already all knew this, which is why the stock has been going down for 2 months at this point. So why is this happening? Well, production got slowed in Q1 because there was an arson attack at the Gigafactory in Berlin. Also, since 2022, when interest rates went up, there has been a slowing of demand among car buyers, specifically for EVs and more expensive vehicles. And to fight that trend, they have been reducing their vehicle prices since 2022, basically. And that has continued into Q1, and this hurts margins, resulting in a 5.5% operating margin in Q1, which This used to be around 20%, so that's a big drop off. Actually, let's look at what it was. So in fiscal 2022, their operating margin was 16.76%, and now we're down to 5% in the latest quarter. So that is a huge drop off. So when you look at all of this, it becomes pretty obvious why there may be continued buying opportunities long term for Tesla in 2024. That is, if you're optimistic about it. And I have a feeling the company is pretty optimistic, so I will listen to their earnings call and figure out why the stock is up 13.3% after hours.
In terms of the new product roadmap, there's been a lot of talk about our upcoming vehicle line in the past several weeks. We've updated our future vehicle lineup to accelerate the launch of new models ahead. Previously mentioned start of production in the second half of 2025. So we expect it to be more like the early 2025, if not late this year. These new vehicles, including more affordable models, will use aspects of the next generation platform, as well as aspects of our current platforms, and will be able to be produced on the same manufacturing lines as our current vehicle lineup. So it's not contingent on any new factory or massive new production line. It'll be made on our current production lines much more efficiently.
You guys just heard that. That's a big announcement because there was a false report that came in the past few weeks that their next generation vehicle program, which is supposed to be the low cost, high volume, this is going to be like their next big growth initiative in automobiles. There was a false report that it was canceled. However, Elon refuted that, and he just reconfirmed on this earnings call that it is happening and it doesn't require a new factory being built, which is what the rumors were, that it was going to be a gigafactory in Mexico. That is not true and is still coming. And their plan is early 2025. So that there is enough reason for the stock to go up 10% or so.
Regarding FSD version 12, which is the pure AI-based self-driving, people that if you haven't experienced this, I strongly urge you to try it out. It's profound, and the rate of improvement is rapid. So we've now turned that on for all cars with the cameras and inference computer and everything from hardware 3 on in North America. So it's been pushed out to, I think, around 1.8 million vehicles. And we're seeing about half of people use it so far. And that percentage is increasing with each passing week. Since the launch of full self-driving, supervised full self-driving, it's become very clear that the vision-based approach with end-to-end neural networks is the right solution for scalable autonomy. And it's really how humans drive. Our entire road network is designed for biological neural nets and eyes. So naturally, cameras and digital neural nets are the solution to our current road system. To make it more accessible, we've reduced the subscription price to $99 a month, so it's easy to try out. And as we've announced, we'll be showcasing our purpose-built robotaxi or cybercab in August.
So they did a free trial for every single Tesla vehicle that qualified, which was, he said, was 1.8 million cars. And about half of them have been using autopilot. And then they reduced the cost of full self-driving autopilot to $99 a month, which is a significant reduction from the prior cost. So the adoption rate will probably be significant from that free trial. Also, the robotaxi announcement in August, that will be another big deal for the long term of Tesla. This is one of those things where I know it will happen, but I'm not sure the timetable of when it will become significant. All right, so they just gave some commentary regarding free cash flow, why it was so low this quarter, and some expectations for the near future.
We had negative free cash flow of $2.5 billion in the first quarter. The primary driver of this was an increase in inventory from a mismatch between builds and deliveries, as discussed before, and our elevated spend on CapEx across various initiatives, including AI compute. We expect the inventory build to reverse in the second quarter and free cash flow to return to positive again.
So they expect it to return to free cash flow positive again. Let me just tell you, I hope so too. I am investing in the company. I am hoping they make money. So hopefully it's not just positive and it's, 3 or 4 years from now, $15 billion positive.
The second question is on Optimus. So what is the current status of Optimus? Are they currently performing any factory tasks? When do you expect to start mass production?
This is a very important question if you're investing in Tesla long term, because Optimus and the Tesla bot program, that will be a big part of the long-term growth thesis. If you think this can eventually be, a $5-10 trillion company, this is going to be part of that. So this is an important question.
We are able to do simple factory tasks, or at least I should say factory tasks in the lab. In terms of actually, we do think we will have Optimus in limited production in the actual factory itself, doing useful tasks before the end of this year. I think we may be able to sell it externally by the end of next year. These are just guesses. As I've said before, I think Optimus will be more valuable than everything else combined, because if you've got a sentient humanoid robot that is able to navigate reality and do tasks at request, there is no meaningful limit to the size of the economy. That's what's going to happen. And I think Tesla is best positioned of any robot maker to be able to reach volume production.
So production end of 2025. That's one date where I'm sure that might be delayed. And my intuition was thinking 2026 is when it would probably start small. But I do think, over 5 to 10 years, this is going to be a gigantic business. It will be in industrial settings. It will probably be in the home too. And this is one of those rare opportunities where you're creating an entire new industry. So I found another interesting part of the call. They're talking about FSD regulatory approval, and then talking about how the robotaxi future will work with autonomy.
And they have obviously been operating in San Francisco for a while. I think they got approval for City of LA. So these approvals are happening rapidly. I think if you've got at scale a statistically significant amount of data that shows conclusively that the autonomous car has, let's say, half the accident rate of a human-driven car, I think that's difficult to ignore, because at that point, stopping autonomy means killing people. So I actually do not think that there will be significant regulatory barriers, provided there is conclusive data that the autonomous car is safer than a human-driven car. And in my view, this will be much like elevators. Elevators used to be operated by a guy with a relay switch, but sometimes that guy would get tired or drunk or just make a mistake and shear somebody in half between floors. So now we just get in an elevator and press a button. We don't think about it. That'll be how cars work. You just summon a car using your phone. You get in, it takes you to a destination, you get out.
You don't even think about it.
You don't even think about it.
Tesla, the world's largest elevator company.
Think of Tesla like, some combination of Airbnb and Uber, meaning that, there'll be some number of cars that Tesla owns itself and operates in the fleet. There'll be some number of cars, and then there'll be a bunch of cars where they're owned by the end user, but that end user can add or subtract their car to the fleet whenever they want. And they can decide if they want to only let the car be used by friends and family, or only by 5-star users, or by anyone. And at any time, they could have the car come back to them and be exclusively theirs, like an Airbnb. You could rent out your guest room or not anytime you want. As our fleet grows, we have 7 million cars, 9 million cars, eventually tens of millions of cars. Constant feedback loop. Every time something goes wrong, that gets added to the training data, and you get this training flywheel happening in the same way that Google search has the sort of flywheel. It's very difficult to compete with Google because people are constantly doing searches and clicking, and Google's getting that feedback loop. It's the same with Tesla, but at a scale that is maybe difficult to comprehend.
In my view, autonomy is going to be the clear value driver for Tesla over the next 5 years. And I think that will be obvious in hindsight. Here is another important clip where Elon basically sums it up very well for investors right now. If you're investing in Tesla in the next 5 years, you basically have to believe that self-driving unsupervised will happen in that time frame, or else the stock will not do well, because they're betting the entire company on that being a large value creation.
Really, the way to think of Tesla is almost entirely in terms of solving autonomy and being able to turn on that autonomy for a gigantic fleet. And I think it might be the biggest asset value appreciation in history when that day happens, when you can do unsupervised full self-driving.
If you're investing in Tesla, you have to believe that that's going to happen and that Tesla will lead the charge, and most of the value created will accrue to that company, either through their robotaxi network or people paying their subscription for FSD, etc. But then there was another interesting announcement later. I'll go to that clip.
Of the legacy automakers contacted Tesla about possibly licensing FSD in the future.
We're in conversations with one major automaker regarding licensing FSD.
This is the big money maker. Licensing full self-driving to other car manufacturers. None of them can do it themselves. Licensing FSD, then it broadens their market outside of Tesla manufactured vehicles to the broader automotive market. That would be a big deal. Hello, it's now Wednesday, and I found two pieces of news that are a little interesting to discuss. They both have to do with President Biden, or as some of you may refer to him as, Sleepy Joe. So first, he signed the TikTok ban bill today, which we all kind of knew was going to happen because it passed the House a few weeks ago, and he said that he was going to sign it if it passed the Senate. So I'm going to cover that from three different perspectives. The perspective of a user, a content creator, and then more of like a political lens in terms of the country. So as a user, I mean, short form video for the most part is kind of brain rot, to be honest. We all know about like doom scrolling where you just get stuck and then you teleport an hour later, and how much value can you really pack in that short of a time? The answer is none. I'm a big fan of long form content for the most part. Podcasts. This is, I guess, my version of a long form content with, a solo show, not a podcast. But from the perspective of a user, much of TikTok's features in short form video are now being integrated into all the other major social media platforms. We have Instagram Reels, which is also on Facebook. I don't use Facebook. I'm 25. And then YouTube Shorts is the other big platform. However, we also have videos on Twitter, and they are considering bringing back Vine, which they used to own. They probably should just make that another tab on Twitter, and it will just basically look like TikTok. So in terms of the user experience, all of that content, you're still going to get basically all of it. Now, from the perspective of a content creator, a lot of people built businesses for the past 5 years on TikTok. That entire time, it was pretty obvious to me that you'd want to move to other platforms, specifically YouTube Shorts, and then build out a long form audience on YouTube. YouTube has better tools in terms of community building and monetization. If you think about it, when you're on YouTube, you're specifically looking for creators. Whereas on TikTok, it's just an automated AI feed that learns what you're into. You're not necessarily seeking out someone's content. YouTube and, like a podcast feed, it's kind of like your hub of content. Whereas this, TikTok, you're at the mercy of the algorithm. That still happens in YouTube, but it's more of a library type thing where people can go back and watch your old videos. So is the TikTok ban good? Well, I mean, for people's mental health, probably. But then again, as I just explained, they'll get the same exact things through other platforms now. The behavior will not be going away. And is it good politically in the country? In my opinion, no. Now I'm going to read the bill and tell you why. Let me bring it up on the old computer over here. And now, of course, because this is the US government, the bill is 184 pages, even though the only thing people care about is TikTok related to this, and that's only 2 pages. All right, so Division D, Protecting Americans from Foreign Adversary Controlled Applications Act. So what falls in this category? Foreign Adversary Controlled Application. The term Foreign Adversary Controlled Application means a website, desktop application, mobile application, or augmented or immersive technology application that is operated directly or indirectly, including through a parent company, subsidiary, or affiliate by any of ByteDance, which is the parent company of TikTok, a subsidiary or successor to an entity identified in Clause 1 or 2, so ByteDance or TikTok. So that part is pretty specific in that it's just related to those entities. And then we get to B, a covered company that, 1, is controlled by a foreign adversary, 2, that is determined by the president to present a significant threat to the national security of the United States following the issuance of 1, a public notice proposing such determination, 2, a public report that the Congress submitted less than 30 days before such determination, describing specific national security concern involving and containing a classified annex and a description of what assets would need to be divested from to execute a qualified divestiture. Now, it's that part B that I don't like at all. The determination is largely left up to the president and Congress to determine which platform or application is controlled by a foreign adversary. Now, if we just, remember the last 6 years of history or so, maybe it was 7 or 8 now, we have basically been told that Twitter is controlled by Russia. Since Elon Musk bought Twitter, we get those continued claims, and we get even larger accusations that X itself is now a threat to national security. If you pay attention at all, you have seen that language millions of times over the past 2 years. So in my opinion, this bill is way too broad and opens up the door for more action and banning of other platforms and social networks. Another case, we have Truth Social, which isn't really that relevant for the most part. The entire reason why anyone has that is because of Donald Trump, and he was being claimed to be a Russian asset for about 5 or 6 years. There's a clear line of logic that they can use, and you don't really have to think that hard or stretch the imagination to believe that these things could be banned because of this bill. Just a little concern, a little, civil liberties. I like my freedom in the United States, so we'll see where that goes. So with this TikTok bill, they have 9 to 12 months to divest the company, or it will be banned in the United States. Now, what do I think will happen? I don't really know. I have intuitions, but I'd just be shooting from the hip here. But then the other interesting thing I saw circulating on the interwebs today was a proposal that happened in March, and I don't know why it was being resurfaced today, but it is interesting and specific to investing, so I will talk about it. So Biden has a new capital gains tax that he's hoping to get passed in 2025, and he wants to make the top bracket for the highest income earners be 44% on capital gains. That would also apply to dividend income as well for top earners. This wouldn't impact most people, only very high income earners. And with marginal tax brackets in the United States, it's the money earned after that threshold is taxed at that amount. So all the money earned under that is taxed at the other brackets. Do I like that? No. I am hoping to be a high income earner in the future, and I would not enjoy that. And I could give you, a list of arguments that disincentivizes investment, which is good for future planning, investing in new companies, blah, 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 blah. We can go through the whole arguments. We can also go through the double taxation argument where you're already getting your income taxed, which you use that income to buy investments and assets, which would then be taxed at an even higher rate in the future. But then here is the even crazier one, which makes no sense at all. They want to do a 25% tax on unrealized gains. You heard that right. Unrealized gains. So before you even sell a stock, in order to think this is a good idea, you would probably have to be financially illiterate, which most of politicians are. So these are gains you have not even earned yet on money you don't have. Now, of course, this is only for high income earners in their proposal, which I guarantee is not going to happen. What this effectively means is if you start a company and it becomes massively successful and valuable, and you own a high percentage of that company because you created it, then you will be forcibly told to sell that asset and own less of the company over time because you're being taxed on money you don't have. If we use the example of Elon Musk, he owns, I don't know what it is, like 13 or 15% of Tesla or so, but he's not liquid in cash though. He doesn't have that kind of money just sitting around. That's the value of his stake in the business. So in order to pay this 25% tax on unrealized gains, he would have to sell his stake in Tesla. So over time, it's just eroding his ownership. This would be the same for someone like Jeff Bezos and Amazon. Now, this obviously doesn't impact most of us on our personal finance journeys, considering we're like small cats, but it does impact American capitalism as a whole. There's an interesting dynamic right now where as ETFs and everything have become much larger, voting of these major corporations becomes controlled by these other entities and no longer by individuals. So when you kick the founders' control out of these companies, you're making it even more less controlled by influential individuals and the people who actually got the business into that position in the first place. We're moving more and more into a world where these firms like BlackRock, Vanguard, etc., they outsource their voting controls to these third-party companies, and then they vote the shares of all of these other people who invest in the ETFs. I want Warren Buffett to have influence over Berkshire Hathaway. I want Steve Jobs to have influence over Apple. I want Elon Musk to have influence over Tesla. I want Jeff Bezos to have influence over Amazon. I want Mark Zuckerberg to have influence over Meta. I would much rather have them have influence, the companies they founded, over some third-party voting firm that just is a leech on the system. And although this is only leveraged at high-income earners right now, a 25% tax on unrealized gains, if that ever did become a just generalized, whatever the percentage is, a tax on unrealized gains for lower income earners, so like we fell and were impacted by it, that would still be ridiculous to handle. So yeah, I didn't really want to get all that political today, but I mean, this does impact, topics we discuss regularly. All right, so the rest of today, I'll give you a little market update of what's going on, but then I'll also be doing some website improvements. I need to basically make this is a small feature, but I need to make like a required field when you add a portfolio, because some people were experiencing a problem where they wouldn't enter a portfolio name and then they would be confused why no portfolio was added. There needs to be some kind of requirement or just like message that lets you know what's going on there. And then also I want to start working on the stock screener, which will be big. That will be big. So we'll see what kind of progress I make on that today, but I definitely want to get it going a little. All right, market update Wednesday. Overall portfolio up 1.66%. Days change, that's a $3,600 gain. However, let's go back to our earlier segment. This is an unrealized gain. In fact, I have $77,000 in unrealized gains. My preference would be to not be taxed on that. Now, we know that's only for ultra high net worth individuals, but we also know that new taxes never stay how they're originally introduced. We used to have no income tax in this country. And then we had an income tax that was very small and only for high income individuals. And now we have our massive, progressive tax system in the United States today. I'm only getting a little political because it's connected to the topic I was discussing earlier. In reality, when you're planning for your financial future or how to increase your income or make your business better, you want to basically block out politics as much as possible. For the most part, complete distraction. You as an individual have far more control over your own personal income, investments, wealth, etc. So prepare financially as though that does not exist. So yeah, big gain today, $3,600 gain. This was mostly led by Tesla being up 12%. That's a big gain for me. Everything else, it was just like pretty minor. PepsiCo made up their 3% loss yesterday by going up 3.62% today. That's good for them. Globe Life continued going up, but still down 31% from the 200-day price average. You may have missed the awesome buying opportunity, but it still looks decent. All right, so for dividend news, the only really notable one I see since the last time I updated was MetLife. They increased their dividend 4.8%. This is a quarterly dividend right now, and it's in line with pretty much the 5-year compound annual growth rate. So yeah, market's up today. And remember, you have far more control over your own personal well-being than the government. Continue to learn, increase your skill set, increase your income, spend way less than you make, save and invest the difference. If you're a business owner, reinvest in your business, and keep a long-term focus. Stay disciplined. All right, that's the end of our little pep talk here. I gotta get to work. All right, it's Thursday after market close. Big day, lots of news to cover here. All right, so for earnings, we had Microsoft and Google today. I'll cover both of those. Google, they just announced a dividend, so that's a tease, but I'll dive into it. I'll give all the details. But first, let's just cover what happened in the market today. So my portfolio, it's up 0.37%. Microsoft was down during trading hours about 2.45%, and Tesla was up 4.97% again today. So now that's a pretty big gain for the week on Tesla. So definitely missed my buying opportunity, but I still think, in the summer, possibly, there could be another dip. We'll see. Altria up 1.44%, Broadcom up 2.99%, T. Rowe Price down 2%. So we got some movement, but no new buys for me or anything notable. So let's look at what happened with earnings. Microsoft is up 3.92% after hours. So there's some positive momentum coming out of earnings. So Microsoft is my top stock. I've made a full stock review video in the past if you want to get caught up of what their business model is, how they make their money, etc. So this is fiscal year 2024 Q3 for Microsoft. Revenue came in at $61.9 billion, which is an increase 17% year over year. Operating income for the quarter was $27.6 billion, which is an increase 23% year over year. Net income was $21.9 billion, which is an increase 20% year over year. And diluted earnings per share was $2.94, which increased 20% year over year. And specifically, Microsoft Cloud revenue was $35.1 billion, which is up 23% year over year. And basically everything at Microsoft is growing except for their devices segment, which is, like their PCs like Surface and, their accessories and whatnot. That's down 17% year over year. But that is a very small part of Microsoft. One of the largest and most important part to the long-term story of Microsoft is Microsoft Azure, which is their cloud services, and that saw revenue growth of 31% year over year. And we know from following the company over the past 2 years, they have been leading the charge in the AI boom and making all these partnerships with different AI models, most notably OpenAI, because they have a 50% ownership stake basically in the company. They're also integrating AI throughout their entire software suite with Microsoft Copilot and their entire Copilot stack. So all of this data just came out, but it will flow into dividenddata.com in the coming days, and then you will be able to view it in all of these different graphs and tables, which help you visualize and understand how the recent performance is in historical relation and more intuitively figure out the growth rates that you can expect going forward. You can also get their balance sheet, income statement, cash flow on a quarterly and annual basis. And of course, because this is dividend data, you can view their dividend history, their growth summary with 1-year CAGR, 3-year CAGR, 5-year CAGR, and 10-year CAGR. You can see their payout ratio based on both free cash flow and net income, and then you can see their historical dividend yield over time. Then you can also see the impact of share buybacks, which is significant for a lot of these big tech companies because they rake in the cash. Speaking of companies that rake in cash, let's go to Google. Google is up over 12% after hours. You heard me. 12%. All right, so the Google CEO, Sundar Pichai, said our results in the first quarter reflect strong performance from search, YouTube, and cloud. We are well underway with our Gemini era, and there's great momentum across the company. So Gemini was their recent launch of AI, which was originally Bard, and then it got rebranded and relaunched as Gemini. And that launch was a complete failure. I mean, if you were on the internet, you saw all the images of them making George Washington black and stuff because they hard programmed in a bunch of diversity, equity, and inclusion related things. All right, so how was the financial performance? Revenue was up 15% for the quarter year over year. That's from $69.7 billion to $80.5 billion. Operating income for the quarter grew from $17.4 billion to $25.4 billion. That's an expansion of their operating margin from 25% to 32%. Net income grew from $15 billion to $23.6 billion, and EPS for the quarter grew from $1.17 to $1.89. So Google's big moneymaker is advertising through Google Search, YouTube ads, and then their Google network. So overall, Google advertising grew from $54.5 billion to $61.65 billion. That is a 13% increase year over year. And then Google Cloud, which is very important to them long term. It's the number 3 cloud player behind AWS and Microsoft Azure. That grew from $7.45 billion to $9.5 billion. That's a 28.4% year-over-year growth rate. And here you can see their operating income by segment. So Google Services, which is mostly just advertising, that grew from $21.7 billion to $27.8 billion. And what's really interesting here is Google Cloud is finally increasing in profitability to become more notable. It grew from $191 million to $900 million. So here you can see really when you think about Google, it really all is that ad bad business. That is the cash cow. It made 28 times more than Google Cloud, and Google Cloud itself is a really big business. And then they have these other money-losing businesses like, I assume Waymo's in there somewhere, which they're going to lose their ass to Tesla. And then, so total income from operations grew from $17.4 billion to $25.4 billion. So Google has been a cash cow for over a decade at this point. Last quarter, they had $110 billion in cash on hand. And annually, they've had 3 years in a row of over $60 billion in free cash flow. Despite this, they have never paid a dividend. The only money they give directly back to shareholders is through share buybacks. But today, that changes. So Alphabet, Google's parent company, their board of directors today approved the initiation of a cash dividend program and declared a dividend of 20 cents per share that will be paid on June 17th, 2024 to stockholders of record as of June 10th, 2024. That will be on each voting class of the company's shares. So the company intends to pay a quarterly cash dividend in the future. And I assume that will be growing annually. So yeah, I just posted a little tweet about this, and at the current price of $156, the stock would basically have a 0.5% dividend yield, because the annual dividend would be 80 cents per share. The company had annual free cash flow of $5.50 last year. So based on that, we have a payout ratio of 14.5%. This is a payout ratio based on free cash flow. So that is an extremely low payout ratio and still gives Google plenty of flexibility to grow the dividend, invest in their business, do share buybacks, and all of the lot. However, on top of this, the board authorized the company to repurchase up to an additional $70 billion of its Class A and Class C shares. That's a lot of money, and it will continue the recent trend of Google repurchasing shares. But does this mean you should buy the company right now? Probably not. For example, from mid-2022 to mid-2023, Google was at a pretty attractive range, especially relative to the rest of big tech. I thought this at the time, and even like well-known investors like Bill Ackman, I think, bought the stock at that time. And although people worry about disruption in Google search from AI-related threats, I personally think that Google search will still be pretty dominant for the foreseeable future. It will continue to grow. YouTube is the best entertainment business in the world. You're watching me on YouTube. It's great. All right, so I have to edit this new video. Let me know what you think of this different style, any suggestions, what you liked, what you didn't like. I'm sure I'll just keep experimenting going into the future. This new format will be releasing every Friday at 11 a.m., so subscribe. And after I edit up that last clip, I'm going to go watch the NFL draft at my dad's house. It will be great. We're Washington Commanders fans, formerly the Redskins and the Washington football team. Don't ask about that. Not happy. Not a good name. We have the number 2 overall pick. I am hoping we draft quarterback Jaden Daniels from LSU. We just need a quarterback in general, and I think he's the best option. Other speculation is Drake May or JJ McCarthy. I'm feeling a little less confident in that. But first round quarterbacks, they're such a crapshoot in general. I mean, who knows what's going to happen? But yeah, I'm pretty excited for NFL draft. Huge NFL fan. We did a fantasy football league in the fall for the Dividend Data members. That was good. I crushed you all. You guys suck. And I'm probably going to watch the Pat McAfee show Draft Spectacular. Bill Belichick is on it, which will be great. Great insight. Gonna make steaks with my dad and eat. Adios. Let me know what you thought in the comments, and see you next time.